Picture this. It's 2021, you're 22 years old, you just got your first real paycheck. Not the coffee shop money, the real money. Direct deposit, bi-weekly, with taxes already taken out, which somehow still manages to shock you every single time. You're not rich, but you're not broke either. And for the first time in your life, you have a little breathing room. So you do what any reasonable person does. You open your phone, you open TikTok, you type in how to invest money, and what comes back at you is extraordinary. A 25-year-old in a Lamborghini tells you about options trading. A guy in a hoodie explains how he turned $400 into $40,000 in 3 months. A woman with perfect lighting tells you the stock market is literally free money if you just know the secret. A teenager, an actual teenager, explains crypto yield farming in a 30-second video with a trending sound underneath it. The algorithm feeds you more and more and more. And somewhere in that scroll, a switch flips. You stop thinking about money the way your parents did, boring, slow, patient, cautious, and you start thinking about it the way the internet does. Fast, exciting, a game where the people who move quickest win the most. 3 years later, a lot of those people are quietly trying to figure out what went wrong. Not all of them, some of them won. The internet will make sure you know about those ones. But statistically, the overwhelming majority of Gen Z investors who went in hot between 2020 and 2023 came out worse than if they had done almost nothing. Some came out significantly worse. And the painful part, the part nobody wants to say out loud, is that they were not stupid. They were not reckless. They were just working with a map that was drawn to benefit someone else. This video is about the financial mistakes Gen Z is making right now. Not in a scolding way, not in a kids these days way, but in the way that a slightly older friend who has studied this stuff might sit you down and say, here is what is actually happening. Here is what it is costing you, and here is what you might want to think about instead. No hype, no products to sell, no inspirational music under the voiceover, just the uncomfortable math. Let's start at the beginning. The financial education you never got. Here's a foundational problem that nobody likes to talk about, because acknowledging it means acknowledging a pretty significant systemic failure. Most Gen Z, and really most millennials and most of Gen X, and honestly most Americans full stop, were never actually taught how money works, not in any meaningful way. You might have had a class in high school that covered checkbooks, maybe compound interest got a 10-minute mention somewhere in an algebra lesson, maybe your parents sat you down and told you to save, but the actual mechanics of the financial system, how interest compounds against you when you carry a balance, how inflation silently erodes purchasing power, how tax-advantaged accounts work and why they matter, how the stock market is structured and what the rules of that game actually are, most people never got that. And that is not an accident. There's a reason the financial services industry in the United States spends billions of dollars every year on marketing and lobbying and product design. There's a reason credit cards are marketed to college students with free t-shirts. There's a reason the default enrollment on most employer retirement plans is 0. There's a reason payday loan shops cluster in lower-income neighborhoods while wealth management firms cluster in affluent suburbs. Financial illiteracy is not just a personal failure, it's an infrastructure. It's a condition that certain parts of the economy depend on to function. Gen Z grew up in the middle of this infrastructure, but Gen Z also grew up with something no previous generation had: unlimited access to information. Financial content everywhere, free trading apps, crypto on your phone, a sense that the old rules of wealth building were gate-kept by the wealthy, and the internet was finally democratizing all of it. That story is partly true. The access is real, some of the old gatekeeping has genuinely fallen, but access to information is not the same as access to wisdom. And in a landscape flooded with financial content, the loudest voices are almost never the most accurate ones. So before we get into the specific mistakes, sit with this for a second. The very environment Gen Z is navigating financially was not designed with their success in mind. That context matters. It makes the mistakes more understandable, and it makes avoiding them more intentional. Now, let's get specific. The trading trap. Let's talk about what happened between 2020 and 2022 because it set up a lot of the problems we're still seeing play out. March 2020, the pandemic hits. The stock market crashes about 34% in roughly 5 weeks, one of the fastest crashes in recorded history. And then, just as fast, it starts going back up. The government pumps trillions of dollars of stimulus into the economy. Interest rates get slashed to near zero. People are stuck at home with stimulus checks and nowhere to spend them. And Robinhood and apps like it see their user growth explode. In the first quarter of 2020, Robinhood added 3 million new accounts. By the end of 2021, they had nearly 23 million. The average age of a new Robinhood user in 2020 was 31, but a massive chunk of that growth was coming from people in their early 20s and late teens, many of whom had never bought a single stock before. Now, here's the thing you need to understand about the market environment from mid-2020 through the end of 2021. It was fake. Not in a conspiratorial sense, but in the sense that almost nothing about it reflected normal market conditions. Interest rates at zero meant that money had basically no cost. Stimulus was flowing directly into consumer accounts. Institutional investors were starved for returns and pouring money into riskier assets. The entire risk appetite of the market had shifted. In that environment, almost everything went up. Meme stocks, crypto, SPACs, NFTs, speculative tech companies with no revenue, it didn't matter. Everything was going up. For a first-time investor opening a trading app in 2021, the experience was, I buy things, they go up, I make money. Conclusion? I'm good at this. That conclusion was almost universally wrong. The market was going up. Almost anything you bought was going to go up. A dartboard would have worked. But the apps were designed to make the experience feel personal and skill-based. The confetti animation when you made your first trade, the leaderboards, the social features, the push notifications telling you when stocks were moving. It was engineered, deliberately engineered, to feel like a video game. Because if it felt like a video game, you'd keep playing. And then 2022 happened. The Federal Reserve started raising interest rates to fight inflation. Money got expensive again. The speculative froth that had been sitting on top of every asset class started evaporating. The Nasdaq, which is heavy in tech stocks, fell about 33% in 2022. Crypto crashed by 70% or more across most major coins. Meme stocks collapsed. SPACs cratered. The entire risk-on party ended more or less simultaneously. And the people who had learned to invest in 2020 and 2021, who had built their entire mental model of how markets work based on an 18-month period of essentially free money, those people got absolutely devastated. Here's the mistake, stated plainly. Most Gen Z investors who started between 2020 and 2022 confused a bull market with skill. They didn't develop a system. They didn't have a thesis. They were surfing a wave and thought they were swimming. The deeper mistake underneath that one is the belief that active trading is how you build wealth. It's not. For almost everyone who tries it, active trading destroys wealth. This is one of the most well-studied phenomena in behavioral finance. It even has a name, the performance gap. The performance gap refers to the difference between what a fund or asset actually returns and what the average investor in that fund actually earns. The gap exists because people buy high after prices have already risen and the news is good, and sell low after prices have fallen and the news is bad. They move in and out at exactly the wrong times. A study from Dalbar, which has been running this analysis for decades, found that over a 20-year period ending in 2020, the S&P 500 returned about 7.4% annually. The average equity fund investor returned about 2.9% annually. Nearly 5 percentage points of difference, not because of fund fees, but because of timing decisions. Active traders fare even worse. A study out of UC Berkeley found that the most active traders underperformed by more than 6 percentage points per year. And that's before taxes, which makes it worse, because every time you sell a profitable position held for less than a year, you pay short-term capital gains tax, the same rate as ordinary income, which for many people is 22 to 24% or higher. The trading trap is elegant in its design.
It's fun, it feels productive, it generates a constant stream of small wins and losses that keep you engaged, and it quietly and steadily transfers your money to the people on the other side of your trades, which are in most cases professionals running algorithms that are faster and better informed than you will ever be. This is not pessimism, this is just math.
The crypto chapter. We cannot have this conversation without talking about crypto. Not because crypto is inherently a scam, that is a debate for another day, but because the way Gen Z encountered crypto created a specific set of financial mistakes that are worth examining carefully. Let's set the scene. Bitcoin has been around since 2009. For most of its existence, it was a niche thing, held by libertarian idealists, tech enthusiasts, and a relatively small number of speculators. Then, in late 2020 and through 2021, something changed. Institutional money started moving in. Major companies put Bitcoin on their balance sheets. El Salvador made it legal tender. The narrative shifted from weird internet money to digital gold to the future of all financial infrastructure. Celebrity endorsements flooded in. Super Bowl commercials ran. Matt Damon told you that fortune favors the brave over a sweeping cinematic score. And the prices went insane. Bitcoin went from around $10,000 in October 2020 to nearly $69,000 in November 2021. Ethereum went from around $300 to nearly $5,000 in the same window. Smaller coins, Solana, Dogecoin, Shiba Inu, posted gains that made those numbers look modest. For Gen Z, crypto had a specific appeal that went beyond just returns. It felt like the establishment was finally wrong about something. The old guard, banks, governments, financial institutions had dismissed it for years. And now look, it was working. It was growing. It felt like being early to something that was going to reshape the world, and the combination of financial upside and cultural identity made it uniquely compelling. Then, 2022. Bitcoin fell from its peak of $69,000 to around $16,000. Ethereum fell proportionally. The smaller coins were often far worse. Many fell 70, 80, 90%. And then the contagion started. Three Arrows Capital, a crypto hedge fund, collapsed. Celsius, a crypto lending platform that had promised customers yields of up to 18% on their deposits, froze withdrawals and eventually filed for bankruptcy. FTX, which at its peak was the second largest crypto exchange in the world, valued at $32 billion, collapsed in the span of about 10 days in November 2022, taking billions of dollars of customer funds with it. Its founder, Sam Bankman-Fried, who had been on magazine covers and testified before Congress as a responsible voice for the industry, was arrested and later convicted of fraud. The losses for retail investors were staggering. A 2022 survey found that among Americans who had invested in crypto, about half reported that their investments had lost money. A significant percentage had lost more than half of what they put in. Now, here are the specific mistakes embedded in how Gen Z engaged with crypto. Mistakes that go beyond just buying a volatile asset. Mistake 1. Treating yield as income. Platforms like Celsius and BlockFi were offering what sounded like incredible interest rates, in some cases double digits annually, on crypto deposits. People treated this like a savings account. They were not. Yield in crypto was generated by lending your assets to other speculators with borrowed money. The risk was enormous and in most cases was never clearly disclosed. When the market turned, the loans went bad, the platforms collapsed, and the deposits were gone. Mistake 2. Leverage. Crypto exchanges made it extraordinarily easy to trade on leverage, borrowing money to amplify your position. 10 times leverage, 20 times leverage, even 100 times leverage was available on some platforms. In a rising market, this looks brilliant. In a falling market, a 10% drop wipes out a position entirely. Many young traders discovered this lesson at a very high cost. Mistake 3. Conflating belief with investment thesis. A lot of Gen Z crypto holders were genuinely convinced, and in some cases still are, that crypto is the future of money. That belief might even be correct, but this technology will eventually succeed, and this is a good investment at this price and at this time are two completely different statements. You can be right about the technology and still lose money if you buy at the wrong price. Mistake 4. Concentration.
Putting a significant portion of your net worth into a single volatile asset class, especially one that has limited correlation with the rest of your financial life, no income stream, and no intrinsic valuation methodology most people agree on, is a risk profile that traditional finance would consider extreme even for sophisticated investors. For a 22-year-old with limited savings and limited income, it can be catastrophic. The crypto chapter of Gen Z's financial history is not over. The markets have recovered significantly since 2022 lows. Bitcoin hit new all-time highs in late 2024. People who bought the bottom and held are doing well. But here is the uncomfortable question underneath all of it. If you need a specific set of market conditions to make money on an investment, and you need to sell before the next set of market conditions arrives, and you need to not panic when the price drops 60% in the middle, is that a financial strategy or is it a bet? There is a difference, and knowing the difference matters.